What if I told you the next recession won't start with layoffs, housing crashes, or stock market panic, but inside a quiet corner of the financial system that almost nobody is watching? A place so fundamental, so ordinary, that most Americans never think about it. Yet it controls the price of their mortgages, the value of their savings, and the stability of the entire global economy. Today, we pull back the curtain on the U.S. Treasury market, the backbone of world finance, and explore the unsettling signs pointing toward a hidden trigger that could ignite the 2026 recession. And the most haunting part? The fuse may already be burning. To understand how we got here, we need to rewind. The U.S. Treasury market wasn't always the most trusted asset on Earth. It became that way over decades, through wars, depressions, financial crises, and geopolitical power shifts. After World War II, as Europe lay in ruins, the United States emerged as the world's lender, industrial engine, and global reserve. Figures like Harry Dexter White helped design the Bretton Woods system, anchoring world finance around the U.S. dollar and, by extension, U.S. Treasury bonds. But the stability that system promised came with hidden cracks that would only widen over time. The twists begin with deficits, foreign buyers, and a market growing so large and complex that even small disruptions now ripple across the entire global economy. Treasuries became the safe asset every pension fund, bank, government, and corporation relied on. When markets panic, they run toward treasuries, not away. But in the last decade, something changed. The origins of the problem can be traced back to 2008, when the Federal Reserve began aggressive quantitative easing, absorbing trillions in government debt. This distorted normal demand and supply. Then came the pandemic. The U.S. printed nearly unimaginable amounts of money, issuing a flood of new Treasury securities. Foreign buyers, Japan, China, and others, began quietly stepping aside. Within a few years, the U.S. Treasury market became more fragile, more volatile, and more dependent on a single buyer, the Federal Reserve. And that dependence is exactly what sets the stage for the 2026 breaking point. The rise of the problem accelerated when interest rates surged. The Federal Reserve raised rates at the fastest pace in 40 years, forcing the Treasury to pay higher yields to borrow money. That alone would have been bad. But combine high interest costs with record deficits, and you get a dangerous feedback loop. The more the U.S. borrows, the more it weakens confidence in its ability to borrow. Meanwhile, banks and financial institutions have been hit by massive losses on the treasuries they already hold. Something that was once considered risk-free suddenly became a source of stress. Liquidity, meaning the ability to buy or sell treasuries easily, began drying up. Bid-ask spreads widened. Flash crashes appeared during quiet market hours. For a system built on certainty, the uncertainty was unsettling. The breaking point emerges when demand suddenly fails to meet supply. Imagine the U.S. holding another treasury auction, one of the largest in history, and for the first time, major buyers refuse to step in. The auction tails, meaning yields spike unexpectedly. Panic spreads through bond markets. If treasuries can't be sold at stable prices, everything that depends on them, pension funds, banks, mortgage rates, corporate lending, begins to wobble simultaneously. This is the hidden trigger, a treasury market liquidity freeze. A silent failure inside the system, not visible to the general public until it's too late. The fallout would be immediate and widespread. Bond yields would jump sharply, pushing mortgage rates toward 9 to 10%, freezing the housing market. Banks already nursing losses would face new write-downs. Stock markets would tumble as investors demand higher returns for risk. The U.S. government's interest costs could spiral, forcing spending cuts, political paralysis, and a loss of global confidence in American fiscal management. Companies would halt hiring, consumers would pull back, and recession would begin, not with a bang, but with a failed bond auction. Attempts to fix this would likely make things worse. The Federal Reserve could jump in with emergency purchases, yet that risks reigniting inflation. Congress might attempt spending cuts, but that risks triggering a political crisis. Foreign buyers may step in temporarily, but long-term trust has already frayed. Every solution introduces a new problem. This is the cycle the U.S. has entered. High debt, high rates, weak demand, fragile markets. Now, look at modern parallels. Japan, the world's largest holder of treasuries, is selling to defend its own currency. China has been reducing its treasury exposure for years due to geopolitical tensions. Even U.S. banks are less willing to absorb new debt after the 2023 regional bank collapses. This leaves the treasury market with fewer reliable buyers than any time since the 1970s. Meanwhile, U.S. Deficits are projected to surpass $1.8 trillion annually, even in normal economic conditions. The system is repeating patterns we saw in the 1970s inflation crisis, the 1980s bond panic, and the 2019 repo market failure. History doesn't repeat, but it rhymes, and the rhyme is getting louder. So where does this leave us? 3 takeaways stand out. First, recessions don't always begin where most people expect. The weakest point in the global economy today is not tech stocks or housing. It's the plumbing underneath everything, the Treasury market. Second, the U.S. is entering a new era of financial fragility, where debt levels, political gridlock, and global competition undermine the stability Americans once took for granted. Third, when liquidity disappears, markets fall faster than anyone predicts. The real danger is not slow decline, it's sudden breaks. Here's the warning. The stage for the 2026 recession is already built. Every month brings higher deficits, higher interest costs, and more strained Treasury auctions. And while no one can say the exact day or hour the system will snap, all the ingredients are already in place. If you want to stay ahead of what's coming and understand the forces shaping the economy you live in, make sure to subscribe. Because the next financial shock won't come with a warning siren. But together, we can decode the signals before they erupt.